Let's talk about dumb things that buyers do while they're under contract. This is Shaheedah Hill, getting you over the hill to home ownership and helping you confidently buy your first home. I don't mean to say dumb, I just wanted to get your attention. These are things that you should not do when you're under contract to buy a house. I'm going to give you 5 things that would not be a good idea that can take you from pre-approved to not approved or denied. So let's go over the 5. Number 1 is starting to pay your bills late. Okay, so you got pre-approved. Remember, you're just pre-approved, you're not approved yet. So at any time that lender can pull your credit again. And I've had not a client, but I've had a viewer email me frantically because their husband had paid some of their bills late while they were under contract for new construction, and it dropped their credit score. A 30-day late, a 60-day late could drastically drop your credit score, because what you're saying to the lender is, I can't afford to pay my bills possibly. And it could just be that you have been irresponsible, you got really busy. It's not that you didn't have the money, but to a lender it looks like, okay, this person is having trouble paying their car note or trouble paying their credit card bills. Why would we give them more money, like a mortgage, a bigger debt, if they can't pay their regular obligations? So not only does it drop your credit score, it's a huge red flag for underwriters that are going to look at your current finances, your current credit score, and see, okay, well, this is a red flag. It could result, and it did result in that client, not that client, but that buyer not being approved. So continue to pay your bills on time. Number 2, at the very beginning, when you get pre-approved, they're going to ask you for things like your check stubs, your W-2s, that sort of thing. Now, this was one of my clients. They gave incorrect or old or altered, I don't know exactly which one, check stubs. So I want you to know that once you get the pre-approval, they look at your check stubs and they kind of trust what you're saying. But then you'll go through underwriting. And the underwriting, based on the check stubs or your places of employment that you say you work, they are going to call those places. And in this example, they called one of the places that was a check stub that the client submitted, and he didn't work there. And not only did he not work there, he hadn't worked there in over a year. And that became a huge red flag. They were denied the loan from this one lender, and then they had to go back and find another lender. And so they were able to close on the house. However, the loan was delayed, the closing was delayed. They had to get a whole new lender, submit all new paperwork that was accurate without any check stubs from the old job. So don't do things like that. They will verify everything or almost everything that you submit. Count on them calling your job to still see if you work there. Count on them following up on any rental verification you may give them. Count on them calling your job. Just count on them to verify the paperwork that you submitted. All right, number 3. Sorry, if you haven't watched my underwriting video, watch that next. Number 3, becoming self-employed. So you have started out maybe with a W-2 job. That's what you have in your check stubs. That's what you submitted to the lender. And then at some point during this process, and sometimes again, this process might be lengthy, and you might be building your house, or it just might be a longer process. And at some point you decide, I want to switch jobs, which sometimes is okay if it's a very comparable job, comparable salary, and you let your lender know. So if there's any time you're going to change your job before you commit to the new job, call your lender and see if this is going to be an issue, because you may want to stay on that job long enough to close on your home. Now, but this happened to a client of mine too. They went from being a full-time employee, and they left that job, and they were also full-time at the new job, but the new job was a temporary to permanent position. Okay, so they weren't a full-time permanent employee, even though the second job paid them more, because they were thinking, this is great, I'll get paid more. And what they did, they hadn't found a house yet, they weren't under contract, but they wanted to increase their pre-approval amount. So they gave them the new information, the new job, the new everything. And again, red flags for the lender. They said, is this a temporary position or is it a permanent position? And it was a temporary position. They thought after they worked there for about 3 to 6 months, it should become permanent. And that would not work for underwriting because they want to see if it doesn't become permanent, then you're out of a job. So it's more of a risk to get approved for a mortgage. So you want to be very cautious. Anytime you're switching from a W-2 to a 1099, any kind of new employment, new ventures, definitely from an employee to being self-employed, check with your lender to see if it will impact your ability to qualify. Now, if you haven't already, please like and subscribe to my channel. There's a link below to get you started with homeownership, a good checklist for you to have, and so you know exactly where you should start. Number 4, avoid large purchases, particularly when you're under contract. A lot of times you're really excited about the new house, you're under contract, you might buy a refrigerator, you might buy furniture, you might buy something, and God forbid you put it on credit. Not only did you open a new credit account that might impact your credit score, you've increased your debt possibly, or if you're just paying it cash, you've reduced the amount of money in your bank account, which comes up another red flag with the underwriter to perhaps look at that amount and see, okay, what are you spending money on, that sort of thing, especially if you're supposed to have cash reserves. So in all instances, it's not a good idea to make a large purchase during the time that you are under contract. And you're asking me probably, well, what's a large purchase? It really depends on your income as to what an underwriter would consider a large purchase. So if you're making $300,000 a year, spending $500 or $1,000, wouldn't be usually a big deal. But if you're making maybe $30,000 or $40,000, maybe $1,000 purchase would be a big deal. So before you make any large purchases, check with your lender first. Like I've had a client before call me outside the grocery store and say, can I buy groceries? It's not that serious. But any large purchases, and definitely don't charge any large purchases on your account while you are in underwriting. Definitely ask first. All right, number 5 is the last one, is large deposits into your bank account. So when you're going through the pre-approval and approval process, they are counting on all the income for your down payment, your closing costs to come from you, unless you've already documented that you're using gift funds or some other funds, maybe from your 401k or some other source. Now, if you have not documented that information to them, they're thinking that perhaps you're getting your down payment or your closing costs from someplace else, and that's a big no-no. So, for example, you say you needed $5,000 for your down payment or $5,000 additional for your closing costs, and you tell your friend, can I borrow $5,000? That person puts $5,000 in your account. Red flag, underwriter, where'd this $5,000 come from? They're really going to wonder where that came from. Why do you have it? Can you not afford your own down payment? All of those things. You will definitely be asked about large deposits that are outside of what like your normal direct deposits, your normal payments, and that sort of thing. So again, it goes by income. $5,000 may not be a big deal when you are used to having that volume in your account, but an underwriter, if they see a large deposit, relative to your income, will point that out, and you will have to say, okay, where that money came from, and it could be, or it could result in your loan being denied depending on where the money came from. Thank you so much, because you want to make it to closing. After closing, do what you want. Still try to be financially responsible, but you have a lot more freedom after you close on your house. Thank you so much for watching. Please like and subscribe to my channel for new videos every week.